Back in the year 2000, New York. One analyst called Harry Marco Polo was tasked with finding out why a popular hedge fund guy called Bernie Madoff was making so much money for his clients, generating 10 to 12% a year returns. Since Harry had been working in this field for a long time, it took him just 5 minutes of examining Madoff's funds to realize that the numbers didn't add up. So he spent several hours later trying to prove that what Madoff was doing cannot be possible without a fraud taking place. Since Madoff was their competitor, he quickly contacted the SEC to let them know about the scheme that Madoff was operating. To his surprise, the SEC did absolutely nothing. Marco Polo sent letters to the SEC in 2002, 2005, 2007, and 2008, but all his efforts were dismissed. Little did they know that they were one phone call away from uncovering the largest Ponzi scheme in the history of mankind. The SEC could have called the DTC to tell them that there were no securities in Madoff's accounts. Unfortunately, they didn't make the call, and Madoff robbed and tool $65 billion from his investor. But why was the SEC so blind to this scheme in particular? And what allowed Madoff to run his operations for decades without being discovered? Also, how could he trick millionaires and billionaires for so long without raising any alarms? Since the creation of his firm Bernard L. in the 1960s, Bernie Madoff built and refined a reputation in Wall Street, steadily building a huge client portfolio. One of his clients was Carl J. Shapiro, the founder of Key Windsor, one of the largest women's clothing companies around that time. This, in addition to institutions, banks, members of European royal families and monarchies, and even celebrities like Steven Spielberg. Like a spider weaving its net, Madoff spread his influence through his charismatic demeanor and successful reputation, becoming a trusting figure within the NASD, the National Association of Securities Dealers, where he was active for a few years with his brother Peter Madoff. They were particularly involved in founding the automated transaction processing system that led to the creation of NASDAQ. This was a game changer for traders because trading was automated and a broader market had been opened. A market Madoff certainly wanted to conquer. Then, around 1986, Bernie decided to move his business to the Lipstick Building, where the 17th floor was made as the base of operation for his scheme. For him, finding his clients was simple. He was accustomed to meeting ultra-wealthy people. He was especially close to his Jewish communities and some trusted individuals. But was that enough to fool these people? The answer is no, because he let his reputation and word of mouth do the job for him. No one could have resisted his promise of consistent 8% to 12% returns from the Wizard of Wall Street. You may ask, doesn't this seem too good to be true, especially for wealthy people who know how money works? You see, he presented his opportunities as being very exclusive, making his offers seem enticing, also used to reject new investors due to a lack of spots available or for not investing enough. This man had a charismatic, almost magical approach when hunting for his victims. Sometimes, his investors saw no choice but to double or triple the amount of money invested in Madoff funds. When he was satisfied by the amount offered, Madoff would say, "I may have a place for you, but don't tell anyone or I won't invest your money." The combination of these tactics and his reputation blindsided many successful investors, and this kept him going for decades. 885 3rd Avenue, Manhattan, New York. There, you will find the famous Lipstick Building. If you head up to the 19th, you will find a legitimate stock trading firm filled with paperwork and computers, where employees take care of investors' money using it to trade stocks. But just 2 floors below that, on the 17th floor, which was referred to as the cage, Madoff had only a few selected employees, and there, something more sinister was brewing. That place was the sanctum of Bernie Madoff, a wealthy trader and philanthropist who, through charm, deception, and manipulation, built the biggest Ponzi scheme, through which he stole $65 billion from his clients. He meticulously operated this scheme inside the 17th floor with a core team of hand-picked fresh employees, Madoff himself, and his closest associate and right arm, Frank DePascali. No one else had access to that floor. No senior employees of the floors above, not even his wife and 2 sons who were working in the 19th floor in key positions. The team on the 17th floor was responsible for fabricating fictitious trade confirmations for investors, claiming to use complex strategies like the split strike conversion to obscure the nature of these false operations. Victims were shown false account statements that included detailed breakdowns of trades and market analysis, and with a constant influx of new investors' funds. You see, older investors were receiving a constant return, thus swaying any suspicions from their side. This made them trust Madoff, because on the outside, we were making them money, but in reality, all their money was deposited into Madoff's personal bank account at JP Morgan Chase Bank. This was a Ponzi scheme, but to be fair, like any other successful Ponzi scheme, his earlier investors made their money back, and they kept making profits over the years, but we're going to come back to that later. As a prominent trader of Wall Street, chairman of NASDAQ for 2 years, and a charismatic philanthropist, Bernie Madoff built the perfect persona that made everyone want to invest their money with him. For decades, the scheme went smoothly, making Madoff's family and his associates wealthy. But like a house of cards, if one card falls, the whole thing will collapse. And a worldwide Ponzi pyramid scheme like Madoff's, one can only imagine how he kept it going for so long. The mortgage crisis of mid-2007 marked the breaking point of Madoff's Ponzi scheme. You see, major institutions were losing money, and the world was facing a financial crisis. With a volatile market, many investors had to withdraw their funds. Many of them were anxious and sought reassurance, which Madoff did as best he could by continuing to fabricate false statements that showed steady gains, masking the growing cracks in his scheme. Bringing new clients was getting harder and harder for Madoff, as fewer investors were willing to put their money into his fund due to the worsening economy, and he was struggling more and more to raise fresh capital to sustain the Ponzi scheme. Madoff's family and longtime trusted employees were unaware of the fraud, so Bernie and his right-hand man Pascali had very limited ability to maneuver through the crisis without increasing suspicion from investors, analysts, and the SEC. But the coup de grace came 1 year later with the bankruptcy of Lehman Brothers, which was the 4th largest investment bank at that time. This sent a shockwave that accelerated panic among investors and markets. What was once his strength has now become his weakness, as the steady 10 to 12% return rate became more and more suspicious amid this financial chaos. Almost every investor was demanding compensation, which in financial terms means to liquidate all investments back to investors. And Madoff faced a tidal wave of money-back requests totaling $7 billion in late 2008, but all that was left from their funds was only $1 billion. He tried to cover the demands by approaching new potential investors, and that was in vain, because the market was in shambles and everyone was fearful. On December 9, 2008, Madoff crossed the tipping point, as he realized that from that point, it was only going downward, and there was no way to continue the scheme. He met with his wife and 2 sons, Mark and Andrew Madoff, and confessed that the investment advisory business was a massive Ponzi scheme and that no money was in reality invested, describing it as one big lie. Bernie Madoff asked his 2 sons not to tell the authorities till next week, because he had intended to wind up his operations over the next few days. To his surprise, the following day, Mark and Andrew consulted attorneys and decided to report their father's crimes to federal authorities that evening. But why did they do that against their father's request? You see, according to their attorney's advice, if they didn't, they would have been considered accomplices in the scheme, and that was the last thing they wanted as a result. So, authorities began preparing for Madoff's arrest. Meanwhile, Madoff privately informed several close employees that the firm was going bankrupt and clients would not be able to retrieve their funds. On December 11th, At 7:30 a.m., FBI agents arrived at Bernie Madoff's penthouse at 133 East 64th Street. They found a calm Bernie in a bathrobe who invited them inside. As he sat down, he looked at them and confessed his crimes. He admitted running a Ponzi scheme and that there was no money left, and stated, "There's no innocent explanation. It's all one big lie." Bernie Madoff was arrested on the spot and he was charged with fraud. He was immediately handcuffed and escorted into custody. Investigators began questioning him about the fraud and how the scheme operated, and tried to grasp the extent of the victims' losses and the size of the Ponzi scheme. He reiterated many times that he acted alone. The next day, a federal court in Manhattan issued a temporary order freezing Madoff's assets. FBI and SEC officials stormed Bernard L. Madoff's investment security offices and began seizing records, computers, and other materials on the 19th floor. Soon after that, they learned about the 17th floor, where the scam was taking place. Upon receiving news about Madoff's arrest, DePascali, his right arm who was working on the 17th that day, urged the employees to get rid of the evidence while he began to consider what steps he might take to protect himself or mitigate his involvement in the scheme. At the same time, the FBI were coming down from the 19th floor to the 17th floor. As they stormed the office on this floor, they asked everyone to freeze and stop what they are doing. The FBI were quite astonished by the materials found on the 17th floor. It was filled with old technology and computers, compared to the high-tech trading terminals and communication used on the floors above it. SEC officers quickly realized that Madoff had been able to easily manipulate them and escape all the audits conducted by regulators. Soon after his arrest, Madoff was granted a bail for $10 million, but he needed 2 people to sign the bail agreement, but his sons refused to sign. Instead, it was signed by his wife, Ruth Madoff, and his brother, Peter Madoff. This gave a strong signal to Bernie Madoff that his sons wanted to distance themselves from anything to do with him. Bernie was under house arrest with his wife Ruth as part of the bail agreement, so he was placed under 24 house arrest with electronic monitoring at his Manhattan apartment. Shortly after, the fraud was revealed to the public. Disastrous news to the more than 10,000 people who, in a matter of seconds, learned that all their savings and investments had been gone with the fraud. What followed was a long, chaotic war of legal procedures between the victims and Bernie Madoff and his associates. Early investigations showed that many red flags and warnings had not been issued, but Madoff literally got away with his scheme for decades, not because he was a genius fraudster, but simply due to his reputation and the incompetence of the SEC officials. Since 1999, Harry Markopoulos, a private fraud investigator from Boston, has tried to investigate Madoff's firm. After 5 minutes of examining the documents, he knew it was a fraud, and after 4 hours, he found that it was a Ponzi scheme. He urged and pushed the SEC to investigate, but his complaints were either ignored or never taken seriously. Once, during an audit, the SEC asked Madoff for his account number to seek records from the DTC, which stands for Depository Trust Company. Bernie knew that if they did that, everything would be over, as they'll be able to verify all trades done by the firm were non-existent. But the SEC never called them, and just like that, they missed the biggest and easiest opportunity to catch the largest Ponzi scheme in history. On March 12, 2009, at age 71, Madoff pleaded guilty to 11 federal felony counts, including securities fraud, wire fraud, mail fraud, perjury, and money laundering. And on June 29th, Bernie was sentenced to 150 years in prison. DePascali also pled guilty in 2009 and was sentenced to 125 years in prison, but his sentence was delayed due to his cooperation with the investigators. In addition to Peter Madoff, who pled guilty in 2012 and was sentenced to 10 years in prison. The rest of the Madoff family only had to forfeit assets and pay money to the victims. The rest of the employees of the 17th floor that were involved in the scheme were sentenced to prison in 2014 after further investigations. They were sentenced to different prison sentences between 2 and 6 years. Bernie Madoff's Ponzi scheme was nothing short of catastrophic. A financial and emotional disaster that destroyed families across all continents. The whole world stood stunned as they learned that the famous magician of Wall Street was, in fact, a fraud. Investors demanded answers and wanted their investments back. Companies and esteemed organizations and charities like Elie Wiesel Foundation for Humanity faced closure. But for others, this tragedy was too much to bear. 11 days after the arrest of Madoff, Thierry de la Villuche, a French financier who lost $1.4 billion of clients' money, was found dead in his Manhattan office. Now, back to the sons of Madoff. Even though they did not receive any prison sentences, they were constantly accused of being part of the Ponzi scheme, or that they knew the whole time. Unable to bear the guilt and devastation, 2 years later, on the second anniversary of his father's arrest, Mark Madoff, who couldn't escape the shadow of disgrace of his family, hanged himself in his home. Wall Street was forever stained by the scandal, and took years to rebuild the trust through a great deal of accountability and internal reforms. The SEC too faced enormous backlash due to their failures, and further investigations revealed deep incompetency and systemic blind spots. Soon after the arrest, the Securities Investor Protection Corporation appointed Irvine Picard as trustee to manage the chaos and liquidate Madoff's firm, and recover some of the funds to compensate the victims. As of December 2023, about $4.22 billion was returned to some of his victims via Picard's handiwork and the U.S. Department of Justice's Madoff Victim Fund. From a trusted pioneer in the finance to the king of fraudsters, Bernie Madoff's Ponzi scheme exposed critical failures in the financial industry, and the 17th floor on the Lipstick Building, which was once the epicenter of a fraudulent empire, now stands as a haunting reminder of lives and greed that toppled fortunes, ruined lives, and, most importantly, it was a lesson for anyone who is too blind when investing their money.